Hey everybody, Brian Gleize here from the Scott Insurance Agency this morning. I'm joined with Michael Helgelson from Keystone. Keystone is an organization that the Scott Agency has partnered with, and what it has allowed us to do is to gain access to the smart people in the world, which is Mr. Michael over here. It allows us to have backroom support on topics when we need it, and the assets that I have availability to at Keystone just allows us to do so many more things. Good morning, Michael. How are you?
Doing great, Brian. Thanks for having me. Appreciate it.
No, thank you. So, hey, this morning we're going to talk about some tricky topics, in my opinion, long-term care and life insurance and how they can marry together. So we're seeing a shift in the market as far as that goes, at least in my opinion, where people are not buying traditional standalone long-term care policies. They are looking at a life insurance policy with a long-term care rider, which is what my wife and I just purchased, So just from a 50,000 foot viewpoint, a high level, would you mind wading into the explanation of a life insurance policy with a long-term care insurance rider on it, please, just to give the folks an idea of what we're talking about?
Absolutely, Brian. So the life insurance landscape has changed pretty drastically in the last few years for the better. Typically, if someone was interested in securing life insurance and long-term care, they'd have to get two separate contracts. A standalone long-term care policy, which is essentially use it or lose it. You're paying your premiums for life on those contracts. It does provide LTC benefits if and when the client qualifies. And to qualify for payments, you just simply need to be diagnosed with a serious mental cognitive impairment, i.e. Alzheimer's or dementia, or someone is unable to complete 2 out of 6 activities for daily living for 90 consecutive days or longer. So think eating, bathing, continence, toileting, transportation, things of that nature. And then the benefits will kick on. So that was kind of how things were done in years past. But now a lot of life insurance carriers have developed ways in which a client can essentially accomplish both items with one policy. Mm-hmm. The long-term care rider, Brian, is essentially just an acceleration on a monthly basis of your death benefit.
Sure.
I like to think of it in terms of it's the new type of life insurance. It's the type of life insurance you don't need to die to be able to use. So it really makes sense for clients that are in the market for permanent life insurance and long-term care coverage. As long as they're healthy and they can get through underwriting and qualify, then they can essentially get both in one policy. The premiums are guaranteed never to increase as long as they don't miss or skip any payments. Unlike a standalone long-term care contract, those premiums can and likely will go up at some point down the road. So that's also something that I feel better positioning riders on a life policy to a client, knowing that they don't have to fear that their premiums may go up. And if they can't afford the higher premiums for the same coverage, they have the option to obviously lower their coverage, but who wants to do that, right?
No doubt. And we've had some real life experiences. One was Jill's grandfather got a letter in the mail. It wasn't a policy that I wrote for him. Grandpa lived to be 96 years old and never needed the use of his long-term care policy or anything like that. So that's absolutely fantastic. But he received the letter that his premiums were going to go up. And that was a tricky letter because a lot of standalone long-term care policies say that your premiums can't go up unless the premium goes up on the entire class of individuals. But we've seen that happen time and time again. So grandpa could either pay the higher premium or get that lowered benefit, which, like you said, nobody really wants. So with the life insurance transaction, with the long-term care rider, the trigger for benefits is the same that it would be on a standalone policy. If you can't do at least 2 of your activities of daily living or a cognitive impairment, it triggers.
That's exactly correct.
There's underwriting on the life policy. There's underwriting on the standalone long-term care policy. So with that in mind, most people don't start thinking about long-term care until, quite honestly, it's way past the time to be thinking about long-term care once they think about it. Okay. So if I'm doing a life insurance policy for a family in their 30s or 40s, because we usually didn't trigger conversations about long-term care until the people's 50s. But if I do a life insurance policy for a younger person, is there any reason that they shouldn't consider the long-term care policy right then and there when they're at their potential healthiest and underwriting is going to go more smoothly?
Great question, Brian. And the short answer, in my professional opinion, is no, they should be considering adding the rider, especially at young ages. If they don't have private long-term care coverage in place already, and they're looking to secure permanent life insurance, it absolutely makes sense to just throw the rider on it, because the premiums will not be nearly as expensive as they will be at later stages in life. Life insurance, long-term care coverage, it's all based off mortality tables. So the closer you are to mortality based upon, average American mortality rates we see in the country today, approximately age 75 for males, approximately age 78 for females, the closer that you get to those ages, the more expensive anything is going to be when it comes to death benefit coverage, long-term care coverage. So 30-year-olds, 40-year-olds, they might not be in their peak earning years yet, but if they're making decent money and they can afford the permanent life insurance price, adding the LTC rider may increase the annual premium requirements by a few $100s. So it's really not that they're not at a disadvantage by doing it sooner than later. Absolutely.
And one of the things that I want to throw in there, what we do as insurance agents is we try to insulate people from Murphy's Law out there, that anything can go wrong, will go wrong. Even if I'm in my 30s or whatnot and I buy a life insurance policy, I'm going to go dark for a second. After a car crash or a dread disease or something like that, if it were to affect us, that long-term care policy can kick in at a young age. It doesn't have to be an older age.
That's exactly correct. Yes. As long as the client qualifies, again, mental cognitive impairment being one of the qualification guidelines, or inability to perform 2 out of 6 ADLs, the benefits will kick in. Now, the benefits on the rider, Brian, is basically just a percentage of the death benefit that accelerates out on a monthly basis once they qualify. Typically, the carriers offer monthly benefit percentage acceleration rates of 2% or 4%. So if you're thinking about securing a $500,000 permanent life insurance policy and you add a 2% LTC rider to that thing, if my math is correct here, I believe that should kick out about $20,000 a month. If you did the 4% option, if you did the 2% option, simply cut it in half. And that's the maximum that the clients can draw, but they don't have to draw the whole exact thing. If they want to take less, they can take less, and it simply extends the period of time that the death benefit is available to draw off of. Because once they've received their full death benefit back, if they're still living, then they're on the hook to pay the cost of the care. So even if a client can't afford to cover the full cost of LTC, something is better than nothing. Because if they have assets, Medicaid, Medicare ain't going to cover it until their assets get below a certain threshold.
And I like what you just mentioned, that the opportunity to stretch the benefit is there, because if you don't need the whole benefit at one time, we can just stretch it out.
Yep.
So this is a 50,000 foot look. We're not going to go into the details, but stories are good. So Alzheimer's runs in my family. My 2 aunts had it. My dad is going through it right now. My wife and I just purchased long-term care at the age of 49 years old, because we're going to structure it through a life insurance policy. Ours is the Nationwide Care Matters 2 program, but we've structured it to be paid up by age 65. so that we can pay on this thing during my income earning years and don't worry about it after I retire as if I'm going to retire at 65. That's not going to happen. But, but we can always hope, right? And the other thing is that on the policy that we purchased, once I go on claim, it simply sends me the amount of funds stated in the contract each month. Now, that is a very generous contract versus a contract that says, you send me all your receipts, and once you've proven that you have spent this much money, now we will reimburse you or indemnify you for that. So the thing that I'll say as brokers, and one of the reasons why I love partnering with Keystone and you guys is because I can collect a person's information, provide it to you guys. You're going to give me a spreadsheet of 10 different carriers and the prices between them. And if the specifics on my client match up better with company A, B, or C. So, Michael, you have helped me so much over the years by saying, this is a list of companies. Brian, I really suggest you look at these 3 companies because they specialize in diabetes, or they specialize in someone that has a celebratory cigar. So I just want my people out there to know that the Scott Agency is a family-owned business since 1935. We employ about 18 people, close to that. Don't hold me to that. But we're not some towering building down in St. Louis or anything. But with the opportunity to lean on individuals like you, Michael, and your staff behind you in Keystone, we are that towering building. We actually have the breadth of the backroom support to take on those cases, look at whether it is a long-term care rider or a critical illness rider or anything like that. So we've been jabbering about this for 14 minutes now, according to my clock. So it's time to wrap this thing up. The biggest thing is, guys, I don't want you to be afraid to have this conversation. And more importantly, I want you to have the conversation with someone that does have the backroom support or the breadth of products that Keystone brings to the table for us. It was a game changer several years ago when we signed on with them, and they just allow me the opportunity to truly help my people. So, Michael, thank you for helping my people. I appreciate you jumping on this call, and we're going to be famous because I'm going to put this out on YouTube and the Scott Agency with a website and all that stuff. But life insurance, long-term care, both of them are tricky conversations, but I can tell you that you will feel better. You will feel better once you have a plan in place. You're going to sleep a little bit better, and we'll go from there. So, Michael, thank you again. I appreciate you being here, buddy.
My pleasure, Brian. And I'll throw out some nice stats to finish up here. Average cost of a private nursing home room in the St. Louis area, just using them as an example for Missouri, is about $6,500 a month. Mm-hmm. Just keep that in mind. 75% of Americans believe that they need long-term care, but currently only 13% have private long-term care coverage. So it is a huge part of comprehensive financial planning that is typically overlooked. The last thing that we want to see happen to anybody is they work their whole life, save for retirement, unfortunately have a situation where they need long-term care, and now they're paying for that out of pocket from their retirement nest egg they built their whole life, and then their family has nothing to show for it.
Michael, what we say on that is that you have a long-term care plan even if you don't have a long-term care plan. If you don't sign up for some type of long-term care health insurance, whether it's through a life insurance rider, whether it's for a standalone, your long-term care plan is to spend down all of your assets until you qualify for Medicaid, and then Medicaid is your long-term care plan. Now, Medicaid is a benefit for tens of thousands of Americans, all right? So I'm glad it's there, but I can tell you that most of my clientele will be happy that it's there, but they won't want it to be their primary source of healthcare.
Absolutely. Absolutely, Brian.
So right on, let's leave it there. To all of you guys that are watching, thank you. Appreciate your trust, appreciate your friendship. If we can help you, our information is going to be right after this, and call us. We'll be happy to help. Have a great day, guys. Bye.
Thank you. Bye now.